Good morning. Assalamu alaikum. Welcome to this session, which is organized by InvestSmart. We have a virtual InvestSmart forum, a sign of the times, obviously, because it can't be done in person. And the topic that we have today is quite interesting in terms of how to diversify and demystify the unit trust and PRS. Now, let me just begin by making my opening remarks of thanking InvestSmart for asking me to moderate this session. My name is Muhammad Rizal. I sit on the board of FIMM, and I have with me today 5 highly qualified professionals from the industry that will be discussing some topics that we think will be relevant for your understanding today. Now, you can participate in this discussion through Slido. I understand that there is an apt link that they will give for you to ask questions. And at the end of the session, there's also a pop quiz where there will be some prizes for vouchers. So I would advise you to participate, stand by. I think maybe some of those pop quiz questions may also be in relation to some of the things that are happening in this industry at this point in time. Now, let me begin by making a very quick introduction of our esteemed panelists. Let me share my screen. And first up would be Cik Amir Ali. He's an independent director for Amanah Raya Investment Management. And he used to be CEO of PMB Investment until 2016. Currently, he is a freelance consultant and trainer in the areas of strategic planning and senior management analysis for investment management and research. He's registered as a financial planner and a certified trainer by the HRDF agency. And he's also an Institute of Corporate Directors for Malaysia. Next up, we have Mr. Danny Wong, who is a fellow board member of FIMM with me. He is a CEO of Arika Capital, and he brings along 25 years of capital markets experience in stockbroking, asset management, and unit trust. He's a fellow member of the ACCA and a member of the Financial Planning Association of Malaysia. Our next panelist is Mr. Edwin Lee, the Chief Marketing Officer of UOB Asset Management. Mr. Edwin is a Senior Director who joined UOB in 2018. He has with him 20 years of experience in various financial industries from banking, life insurance, general insurance, unit trust. And in his last assignment before joining UOB, he spent almost 4 years with an international fund manager where he successfully made the company's presence felt among banks. My next panelist is Ms. Aimee Chan, Chief Marketing and Distribution Officer of Affin Hwang Asset Management. She joined the company as a head of financial institution distribution in 2010 and has assumed the role of CMO in 2014. She was redesignated to her current role in 2017. She has, in financial institution distribution, been responsible for overseeing and driving the growth of third-party distribution channels for Affin Huang, and has developed a team that services the financial institutions and business partnerships. Ms. Chan is a certified financial planner. And our last panelist, Mr. Long Shi Rom, is the head of economic research and communications for Public Mutual Berhad. Mr. Long is the head of economics and research for the investment department in Public Mutual. He joined in 2003, and he oversees the entire economics team, which works on statistical models and databases for economic research covering various regional economies. Prior to joining Public Mutual, he was the managing editor of an investment magazine and has written articles covering the stock market, unit trust, and financial planning. Mr. Long was previously a senior investment analyst with more than 10 years of experience covering various sectors of Malaysia and Singapore's equity market. So collectively, I think we have an esteemed panel with easily 100 years worth of experience as between them to share with you today. Now, let me go into the topics that we want to discuss today. And we will start with some interesting statistics which has been collated by FIMM. Now, sadly, I think today there cannot be a discussion without including the issue of COVID-19. It's a sign of the times. Almost everything that we have seen, has some relationship to the last 7 or 8 months of shutdowns, and also the interrelational effects of other economies also being impacted. But what we find when we look at the statistics, where you would think that the numbers would have fallen off the cliff, that investors would be de-incentivized to participate. In actual fact, the number of accounts have actually increased from 20,087,000 to 20.3 million in those 7 months. And NAV has also increased from 472 billion to 496 billion. So across the board, it has actually done quite well. And what we're trying to start off in terms of today's first discussion topic is, why is the demand for unit trusts and private retirement schemes still encouraging? As I say, instinctively you would think that the market would actually be quieter than normal, would be less inclined in terms of growth. But from the numbers that we have seen, even though it's modest, but there has been some level of growth. And let me start by asking Mr. Long and Mr. Edwin Lee to comment on what their thoughts are in relation to this peculiar development. Let's start with Mr. Long. Let's try and confine your comments to maybe about 3 minutes.
Yeah.
Please.
Thank you. Your question is, why is investor demand for unit trust still encouraging, right? So we think there were a few reasons for the positive demand. Firstly, the local interest rate and offshore interest rate environment was cut to record lows, and this actually boosted the demand. Investors were shifting their savings from fixed deposits into higher yielding assets. Secondly, there was a very sharp V-shaped rebound in the global markets, especially the US and China markets. And thirdly, there was very positive growth in certain sectors that we noticed. So in this pandemic, there were certain sectors such as the e-commerce sector, the healthcare sector that have done very well, and the share price has consequently also benefited. And that has pushed up the sentiment in the market. So I think one of the very fortunate thing about the unit trust industry here is that transactions has been digitalized to a very large extent, and therefore there was no necessity for investors to meet their agents physically. So that was a very positive point why the demand was still very strong despite the decline in the markets.
Thank you. Can I invite Edwin to?
Okay, thanks, Mr. Rizal. Yeah, I do agree with what Long has actually mentioned. Low interest rate plays a crucial point here. I think, as far as I know, I have never seen the Malaysians fixed deposit rates, the 12-month fixed deposit rates, as low as what we are seeing now, about 2%. Yeah, I mean, as long as for the last 40 years that I've seen. And the other thing that I would say, why do we see the Unit Trust or even PRS is looking more encouraging is because also the industry players has becoming more creative when it comes to products. So I recall last 15 years ago when I was just started in this industry, the products varieties are very much confined to only Malaysian strategy, right? But in the last 15 years, we have evolved that, now today you have many varieties of products in the world. Despite, for instance, if Malaysian market is not doing well, okay, you can actually participate in the global equity, in the China equity, and even now, there's so many thematics funds such as technology, healthcare that is available in the market where you can capitalize, like example for this year. These two sectors are definitely doing very well. The other thing that I would say is, my third point is actually on the, this is based on my observation, is a feel-good factor in the year of 2020. In the past recessions, where I noticed is that most of the retail investors tends to lose out, because whenever the market plunge, we will start to see, I mean, as the fund managers itself, we start to see retail investors starting to redeem for the fear factor. And they would not be able to capitalize when the market rebound. But this time around, quite surprisingly, the redemption has been quite very well contained in a way. For whatever reason, it could be due to investors more educated, or even could be because it's a lockdown. Nobody can do any transaction, right? But then again, the good things that we brought to the investors is that they actually right along with the recovery, where they can see a very sharp rebound towards the early second quarter. So the feel-good factor is that that's actually encouraged investors to actually invest more into the unit trust industry. And my final point is actually on the local bourse itself, Bursa Malaysia itself. I think in the last more than a decade, we have seen the retail investor in Malaysia tends to shy away from the local market. But then this year, surprisingly, we have seen that the retail investors has been very actively participating in the local market. And most of them, I would say many of our local retail investors do benefit from the rebound of the market. And that's the reason why the feel-good factor is there. And this encouraged them to actually invest more. So just to conclude, in previously, retail investor will probably prefer to invest overseas, but now investing in Malaysia is like a trend. It's like you must have a Facebook account, kind of trend. Today, the trend is in Malaysia, when you talk to people, they tend to talk about investment. So if you don't have investment knowledge, you don't talk about investment, it seems like you're out of nowhere in the group among your friends. So which is the reason why I felt that this is what encouraged the PRS and the unit trust industry to grow, especially this year.
Thank you for that. so if I can recap, one of the driving factors is very low fixed deposit rates, and the other has been encouraging bounds and rebounds coming from other markets, which we've seen. I think my next question in relation to this would be, do we see that this is something that's durable, or is this just something that is situational because money is trapped? Or thematically, do you see that people have moved into investments of certain segments or certain themes in what they're doing? Maybe I can ask Edwin to elaborate on that, if not some other panelists.
I think I will start. I think now moving forward is very much depends on us, especially the investor, the financial practitioner in the market. Malaysians, I felt this is what my observation is, that investors like to know about the development and they like to be engaged all the time. We have seen in the past when the market is down, some financial practitioners try to shy away from meeting investors, and that actually costs the no confidence. But today, when the market is doing well and we actually manage, we have seen that the retail investors especially manage to ride along with the return, with the rebound of the market. So I think it very much depends on now to keep these investors engaged. And I do agree, moving forward, there could be hiccups in the market. There could be a market turbulence in the market. But then again, I would always encourage the financial practitioner, the agents, or even the financial advisors of banks to keep engaged with investors without giving up. And irregardless whether the market is rain or shine, we should keep up the engagement with the investors.
Can I just add, regarding from the macroeconomics point of view, you mentioned of the low interest rate environment. We think that low interest rate is going to be here for many years. In fact, the Federal Reserve has mentioned that they'll keep interest rates low until 2023. So in this kind of very attractive environment for investment, there could be a lot of turbulence. And I agree with Edwin, there could be a lot of turbulence. And when we talk about turbulence, it may not be negative. It could be just a rebalancing of assets. For example, from the US to the emerging markets, from bonds into equities. And this year we've seen a huge rebound in the tech stocks. So we don't know whether there could be a rebalancing into value assets in the coming years. So it is a very great opportunity for unit trust companies to educate investors regarding the state of the market, the structure of the market and market cycles, so that they can be able to navigate this kind of turbulence.
Thank you for that. I think it's actually a very good segue into our next topic, which is really looking at the investment appetite by way of products and asset classes for investors. Taking from what you've mentioned, that there's a broad amount of choice and there's basically nothing much that you can get out of fixed deposit rates. Where would the investment appetite be by way of products or asset classes? And here I would like to open this discussion for comments, starting with Ms. Chan Ai-Mei.
Hi, good morning, everyone. Okay, this year has been quite an exciting year for us. Despite the pandemic, the MCO that has plagued us, we saw quite a lot of inflows, people investing into bond funds. Okay, so our bond fund sales really skyrocketed. We had huge inflows into bond funds. Besides that, what we also saw was investors were very keen to have that exposure into technology funds, like what was mentioned by Long, because tech funds and tech companies have done really well. And we also launched a global health science fund. It was very opportune because of the pandemic. So that fund also had a lot of inflows. So we saw basically the spectrum of investors that they were either the deposit based out investors going into bond funds so that to get higher returns, slightly higher returns than FDs. And then on the other end, for more aggressive investors, what they did was they invested in technology funds, healthcare funds, the health science fund, and also China, because China being the first country that sort of got out of the pandemic first. So, and China markets also did very well. So this was the investor appetite that we see, and the asset classes that investors basically deployed their monies into. Besides that, of course, we also have some ETFs as well that we also saw some flows, especially into the FANGs type of stocks. Okay, your Facebook now, your Netflix and Amazon and all. So yeah, so these are some of the things that we can share with you in terms of fund flows at our side.
So in terms of the bond funds, I presume that's a more conservative investment, just slightly better than the FD rates. But it surprises me that there's actually a focus on technology funds and global science, because those tend to be quite, I wouldn't say speculative, but what would be the word for it? But it surprises me that you've seen quite a lot of that, that the people would invest in technology at this point in time. Maybe I can invite Danny to sort of chip in on what he's seen by way of products and asset classes.
Thank you, Riza. I think my view is actually in this kind of environment, I think relatively compared to 10 years ago, investors are getting more sophisticated and market has developed, as well as the advancement of technologies, the flow of news, as well as the money nowadays, actually plenty liquidity with the major economies are pumping a lot of, easing of monetary policies. So there's plenty of liquidity flooding the market. So it's a choice of investor to choose their asset classes and as well as the products. So looking at it now, because of the pandemic, I think most of the sectors is being affected, but the benefits sectors, or rather beneficial sectors from this pandemic, left with only few. One of it is only technologies. I mean, already technology in already quite in the forefront of the market, even the past few years ago. But this pandemic has escalated the use of IoT, technologies and whatnot. This has encouraged the growth of these technologies. That's why investors are seeing this sectors being, having the beneficial from this development. And in fact, this effect will stand for longer term. That's my view. As far as the other asset classes like bond, equities, I see that it very much depends on individual risk profile. So I think to be more generic, I would advise investors to look at their own risk profile, right? Understand their objectives, their duration, and not just follow the trend, because you could be a retiree that depending used to be the FD rates for your cash flow, but now you risk money into, let's say, a very thematic fund. That would be very risky, right? So you have to know your risk profile, your duration, your objectives in order to just not look at returns alone. You have to look at risk adjusted return. That is my piece of advice. right? But it doesn't matter what kind of asset classes, so long as you know that suits your each of the objective. And I will always encourage investors to look at different objective, having your emergency fund ready for your whatever rainy days, whatever investable amount of money, split that investor amount, split that into a few so-called objective, or we call it wallet. So if this wallet is for long-term retirements, you have times to perform, then okay, to risk this part, to take slightly higher risk-adjusted return. But if the other wallet is for maintaining of your expenses over the next 12 months, you shouldn't risk that money for that return. In fact, you should compromise a bit of return, but for risk management. So that is actually the way to do things in a very layman term. I will not go into a detail about the asset classes because that will take some time to talk about it. But like Aimee has already briefly described about the trend now. Thank you.
Thanks, Danny. And I just want to follow up a little bit on that. Not meant to be a marketing spiel, but based on the based on the advice that you've given, which I think is very useful, where would an investor or who would an investor talk to in order to get an understanding of that profile? Can it be done online, or are there people who you can come in and talk to? And again, we're not trying to make this a marketing thing, but maybe you can just broadly talk about how it would generally operate for people to get the best advice before they make an investment.
Yeah, there's a very, very good question, Riza. I think nowadays with the advancement of technology, there's a lot of so-called apps, or even some computer program that allowed you to onboard digitally. So you can actually do digital self-assessment of your risk profile, right? But having said that, I'm a person that believe technology is actually part and parcel of our livings, but we cannot rely on that 100%, right? Because no matter how, the computer is created by human. And in investment, it's not just a science, it's an art and a science. And you need human advice. That, for example, certain things when you do a so-called risk profiling using a standard software, they will pose you maybe 10 questions. And then they will just classify you into whatever risk profile, whether high risk profile or low risk profile. But then there's always conflict within the question itself. Allow me to maybe just quote example that there could be one of the questions actually what kind of returns you are looking at. So I may say 10 to 12%. Then the next question comes is actually what's your age? No, I'm age 70. Well, that question itself is really contradicting. So the computer cannot analyze you with the age of 70. Your duration could be only 5-10 years, or maybe shorter than that. Anytime you may use the money with the age, But you choose to be high return. That the computer classify you because of the high return and score certain marks and into this so-called, let's say, moderate to high return, which is sometimes they may not understand further of a personal objective, or whatsoever. But where else? When you face a human, they will ask further, prompt you further question, because the human able to imagine, to understand the emotion of it, and also understand the human side of it, and ask you further, or is this money for your children, for your next generation, or is this for your retirement, or for what? Then they will also highlight more situational risk return profile with investor. So that is actually helping the investor make decisions. So that's why, as I say, sometimes, fee is one thing. I think there's a lot of questions about, when I go through a consultant, then I need to pay a fee. When I go to computer, I don't need a fee. But the service that you need to achieve that is very important. Don't look at the fee alone. You have to look at the objective, the returns, and overall service by a person. Of course, you are savvy enough, you know those things, please, by all means, go to the maybe robot advice. But many of us actually require more advice and then monitoring along the way. You need service personnel. For that 1 or 2% you pay is worth for your 10 years journey. So I think that is the way we should look at it. So you can go through the computer software to do this, or I think better way is actually go through an qualified advisor or consultant in this field. Typically those with the experience, those with, for example, a qualification of like, for example, certified financial planning certification. So that will able to advise you not only to the unit trust, but overall of your wealth management.
Thank you.
Yeah, to add on to that, yeah, Danny, I actually have my FIMM card over here. So just advice to all retail investors, if a consultant comes and talk to you and they want to market the unit trust funds to you, so you need to make sure that they have an authorized card like that. Okay, this one is a combined unit trust and PRS license card. If the consultant is only a unit trust consultant, then it would be something like this. Or if it's a PRS consultant, it'll be something like this. So you just need to ensure that they are licensed, they are registered basically with the Federation of Investment Managers, so that you won't be cheated or your money placed somewhere else. Okay, not where it's supposed to go. Okay, thank you.
Thank you. Are there other panelists that would like to comment on this? Actually, the next question already touches on a little bit of what Danny mentioned. And I was just wondering whether we can move on to the next topic and start broadening that topic. And it's been something that's been discussed in the unit trust world for some time now, where the idea of automation, robo-advisors, versus that of personal service that you may prefer with consultants. And what we've seen in some of the more developed markets is that you have a shift towards robo-advisory, where you can very simply go to a site, understand, and then invest. The question is whether you do understand and whether that advice is necessarily a one-size-fits-all that can help you. And at the other end of the spectrum would be professional consultants that are giving you advisory service, but it's turned out that when you create this two-tier system, the consultant part becomes quite expensive and increasingly is moving towards the more high net worth. So it becomes almost like a two-tier system where if you're a small investor, then you go to the robo-advisory, and if you have a lot more money, then you go to a consultant. And we're not sure whether that's necessarily a good trend for Malaysia. But we do see a marked shift in buying trends from traditional unit trust consultants servicing clients towards a more online sales without human intervention. And that's really a segue into the earlier discussion where do you get your advice from in order to make the correct decisions for your long-term investments. And I'd like to invite Encik Amir to comment on whether fintech is a disruptor or enabler, or maybe a combination of the two in relation to these ongoing developments. And we've seen this happening in banking and stockbroking and other industries where you really can't run away from automation. Encik Amir?
Thank you. Good morning. Assalamualaikum. Rizal and everyone. Fintech can be enabler, can also be disruptor, depending whether we are prepared or not. But let us look it from the perspective of investors, not us, from the companies. From the investors' perspective, what do they want from fintech? They want cost reduction. They want ease in doing transactions. And we have seen this happening in stock market earlier. Previously, there was only one system. You call your dealer's rep or remiser and to transact your orders. And brokerage was fixed. But now with fintech in play, we see the emergence of what we call discount brokers. They can offer lower brokerage, but then no research reports, no reminder serving you. You give the orders direct through online. And this kind of platform is gaining momentum because when you pay less, that means you make more in relative. Why? Some investors, I can see that they do not like recommendation. There are instances where you call reminder, you want to buy stock A, but then you end up buying stock B. Why? Because you are being enticed by the reminder to buy stock A. With fintech, you are in control. But then, you must know what you are buying because you're not being advised. Okay, now we are moving into the stock market. You're in unit trust. If you do not know what you are buying, then you will be in trouble. Therefore, knowledge is very important. Likewise, if you look into the fintech, what we see in EPF, the Employees Provident Fund, for the Members Investment Scheme, or we call it MIS, they have come up with this I Invest online platform. Again, it reduced the cost. Sales charge from 0 to 0.5%. If you go, but then you have the option of going direct to the what they call IPD, Institusi Pengurusan Dana, Fund Management Institution. But sales charge will range from 0 to 3%. So it's your choice. It's the investor's choice whether with fintech you reduce your costs, but with the advice from people, human, personal, you pay a little bit extra. And I understand since May this year until April next year, the charge from EPF is 0, and then from the IPDs is 1.5%. Okay, I've spoken about stockbroking, I've spoken about EPF and IPDs, which is unit trusts, and perhaps now I leave it to Mr. Long. Maybe he wants to talk about unit trusts. But as what I said, my view is that for unit trust industry, buying and selling unit trust through online is inevitable. But investors must be educated, know what they invest or divest. So over to you, Mr. Long.
Yes, thank you. Okay, I do agree that there's a lot of competition that is coming into the unit trust industry, and the same thing that happened with the reminder stockbroking industry. But what is interesting is that in the unit trust agency force, people have increased their education level, their sophistication over the years. We've noticed that because I'm involved in training our agents, and we've been teaching them not only investment, but macroeconomic fundamentals. Now, when it comes to whether the fintech is an enabler or disruptor, I think it may be both. It could be both, because there's huge benefits, as you mentioned, about cost reduction and the convenience. But on the other hand, as the FIM survey has shown in 2019, that more than half of people prefer human interaction. And the other thing is, in an AI model, it is not foolproof. If you let an AI robo-advisor to manage your funds, it is basically into ETFs, is some form of passive investing. Whereas for fund managers, they are faced with a lot of dynamics, which is not so much fundamentals, but it could be psychological. So I'm not sure whether AI systems or robo systems can capture those market anomalies, those market extremities. Just to give you an example, one of the big events this year is the 3rd November US elections, right? You all agree that is causing a lot of uncertainties in the market. There was one American predictor who's using an AI model, a very quantitative model, to predict the winner of US elections. He's done quite successfully, but there were 2 instances where he got it wrong. But the question is, predicting an election is not so easy because it involves a lot of psychological factors. changes in voter sentiment, cultural factors, which cannot be captured by a quantitative model. So I think for investors, even the layman, to understand the implications of such a big event, they need the human element. They need consultants who are well-trained, well-educated, who are objective, who can sort of guide them through this kind of very uncertain geopolitical events. For example, the China-US trade war, that is also very unpredictable. From an economic point of view, a trade war is actually not good. But from the US point of view, they have their own perspective why they would want to raise tariffs, because they feel that the playing field is not level. So it is not a zero-sum game, you know, because there are a lot of dynamics involved in this kind of issues, which cannot be captured by fintech or AI systems. But just to add, from our experience, the fintech convenience is actually something very new. Our agents see that it is a way to become more competitive, to motivate them to become more competitive. So we actually see it as very positive in that sense, that it will motivate them to be more knowledgeable and more efficient in their services.
Thank you.
If I can add,
Yeah,
Cheriza,
please.
I mean, this is where the unit trust consultants, I'm not saying that they are still at the old style, but some are moving on. Unit trust consultants moving on from being a hard seller or salesman to become a financial advisor, financial planning advisor, so that they can advise their clients what kind of asset allocation. So you don't talk about selling your unit trust, product A, product B. You're telling your clients first what's the requirement, the asset allocation based on the objective of their investment, based on their risk profile, etc. What should be their asset allocation in terms of investment in bonds, in equities, and all asset classes, including, not forgetting the cash portion, maybe 5-10%. Then only they will recommend to their clients what are the products that should be put in to build up that asset allocation. So that's advisory. So for those consultants who will survive, they will be the one who will be who are able to advise their clients from this perspective, not only just hard selling products.
Thank you. Thank you. So my takeaway in terms of this topic would be, you know, there are some parts, I suppose, which in terms of the transaction, the execution, which can be done online. So if you see the FIMM nationwide survey report of 2019, you still find that people prefer using consultants, walking into banks. The number in terms of an online portal is still quite small, even though it's growing. And it goes back to this issue of whether we are dealing with an exact science. And if you look at the spectrum of banking, for example, the easiest basic banking of paying and receiving, most people are very comfortable because there isn't a variable in doing those kind of transactions online. But if you go further up the value chain and look at corporate finance or deal related type activities where it has to be bespoke, you can't find those things being made into an online automatic one-size-fits-all type of activity. And I think in relation to the unit trust industry as well, there will be the hybrid of between the two, where there are some things which you can easily do. You can easily put in a transaction. There's no value add in buying online, but the advice part is something that I think will still take some time to evolve. Whether it would necessarily deviate from having consultants making the advice. And And this whole discussion largely is dependent on data. And that really brings us nicely to the next topic of discussion, because when we look at investor protection, especially within an online internet world, the protection of data becomes very important. Even at the FIMM board level, where we're looking to try and store data for the use of consultants in their analysis, in their research, we are also, faced with the spectrum of a data leak, of sensitive information falling into the wrong hands. And this is not something that happens by accident. There are people who actually prey on companies because that data is worth a lot of money. Everything from using, huge databases to resell, to, of course, fraud. And that brings us to the next topic, which is investor protection. We've talked about investor protection, about you dealing with a qualified consultant, a licensed consultant, that they should identify themselves and all these kinds of things. Here, we are taking a different aspect of investor protection, where we are talking about fraud within the online context, where investors should understand their rights and should be vigilant of the need to be aware of scams and fraud. And I think, just moving away for a minute from the unit trust world, we've seen in recent times the Macau scam. There are so many social media type scams in terms of products, in terms of preying on people's greed, sometimes naivety. And as the unit trust world goes more and more into this online world, we will find that there will be inevitably people who try and prey on unit trust investors as well. So let me just open this for comment and discussion, beginning with Encik Amir, to try and get the ball rolling. Amir, you're on mute.
Oh, sorry. Can I share something?
Yeah.
Can I share a slide? Can you allow me to share a slide? No,
Sure.
cannot.
I think you can.
You cannot.
Let me just stop
Okay.
mine. Okay.
All right. I just want to share my slide a little bit so that can you see?
Yes.
Can everyone see? Yeah.
Go ahead.
Okay. How to protect? I mean, this is talking about scam, fraud, etc. Before I talk about this, be careful. Now using Facebook and perhaps Messenger, whatever, they can just snap our photograph. People like me, Danny, Long, etc. And they create one account. People can create one account, and as if that we are selling unit trust from our company, ask people to transfer the amount of money to their own account. So please, never buy through this kind of platform. Okay, that's one. And how to protect oneself from fraud. And one is every one of us must enhance our knowledge on investment. If we want to do investment, we must enhance our knowledge on investment. Just like when we drive our car, we must learn first, get a license, then only we are allowed to drive a car. Okay, so when we want to invest, make sure we know a little bit about investment. And then you must understand product services introduced. Don't buy unit trust, but you do not know whether it's a bond fund or equity fund. And one important factor is manage your desire for wealth. Desire for wealth, anybody has it. I'm not talking about greed. I'm talking about desire for wealth. Everyone has that. Okay. You earn 5,000 now, I want 6,000. And that kind of thing. So if you manage your desire of wealth, then people will not be able to, make you a prey in the investment scam. And one more thing, I'm not very sure. Every one of us 5 panelists, we are all in the management. I was in the management before. I was told not to approve anything when people give me the paper to approve. Okay, my staff may come in. I want this to be approved. I say, okay, put it on my in tray. I let him go out, and then when I'm alone, I will do the assessment. Likewise, you know why? Because I will not be forced by him. His image there, then I approve. Likewise, in investment, don't decide there and then. Okay? That's I think one thing which financial advisor don't like. But for investor, it's best for you to take all the recommendations, go back home, think, evaluate on your own, then only you decide, and then call him back. Okay, and these are the some of the signs of investment scam, which you may want to know. This is non-exhaustive. Too good to be true. Too good to be true. And then high return, guaranteed principal. I don't think any one of us here can offer such thing. And then there are some advance fee apply. You must pay a little bit first before you can participate. Then they will just go and missing in action. And then another one is exclusive for you. If it is so good, exclusive for you, the question is, why don't they make it exclusive for themselves? Because it's too good to be true. And then the offer is only now, or you will miss it. That is another scam, another sign of scam. And then, of course, the last one, unlicensed, unregistered. How many of us really ask people about those who solicit whether you have a FIM card or PRS card or whatever? This is a must. So don't, and we are not talking also only on unit trust. We also should talk also about like Forex. When you talk about Forex, when you deal in Forex, you go into a website. Is that website recognized by SC? Is that website recognized by Negara? So what you need to do is do the checking. Okay, SC has this investor alert list. Go into this website and do the checking. There are a lot of companies being listed as unauthorized. And then you can also do checking on the Bank Negara website, consumer alert and updates. And there are now, as at 18 September 2020, 448 lists on this BNM, Bank Negara list, that are unauthorized companies, website, and whatever. So please check before you do anything. Thank you, Rizal. Over to you.
Rizal, allow me to add. I think it's a very good sharing on that part. I think to be more details, I want to highlight a few points that investors or consumer, already mentioned there's no free lunch. There's no such thing as high returns, but guaranteed principal or low risk. There's no such thing. If there's such a thing, people are coming to arbitrage already. So it will normalize in that case. So put it back to the consumer perspective. I think we as a management company, we do things like train our colleagues, our consultants to be more professional, and they are very, very much improved compared to 10, 20 years ago. And they do KYC on you. But you as an investor, you must do also KYA and KYP, which is know your advisor and also know your product. So you have to verify the advisor, whether he's genuine advisor, whether he's authorized to do it. For example, now showing you a card is not just that. You need to really do additional thing, because like I say, I can always cut and paste. I can produce something back. You can always check the relevant website or where he represents, and he can only represent his company. Of course, he cannot say I am a unit trust consultant, but I'm selling Forex. No, that is not really relevant per se. The other thing is KYP, which is know your products. Always whenever there's a product produced, if it's legitimate, there's always come with disclosure documents, which is like prospectus, and which is like info memo or some form of authorized disclosure documents where they not just talk about the good things about this product, they're always advising about the risk and so forth. Without those part, you maybe have to be slightly more study and got to be doubtful about this thing. Nothing say there's no risk, right? And very important thing is actually on the document itself, they sure provide you with the contact, either with the officers or website whatsoever. Please do such thing, because some of the website you go there, sometimes it's true, sometimes not true, but there's always a contact number there. If it's really want to do a business, a giant business, always there's an office and contact, and only one office and one website, you got to be doubt about that, where they sell you millions of products. You know, that's worth of product. That no such business will just do one office and million product, but only one source of contact. That's, you have to be careful on that. So taking for that, I think if you do your KYA and KYP, things will be quite all right. Typically, actually, sometimes legitimate product will give you some kind of cooling off rights. Sometimes, I mean, a good product, usually they say, okay, if you're not satisfied, come back to me, I refund you. So these are the products, actually, they can, even though not guaranteed, but they can assure you that this is for long term. If within short term you make a wrong decision, you can always exercise your cooling off rights. Now for unit trust, you have 6 days to cool off your rights. You think that your advisor, like what Jamil say, that you go back and think about it, and you think that even though you sign up, but you think that the advisor have misled you or give you less information, you have all the rights to exercise your cooling off, to get back your money, including the fee from the management company. So do study those things like redemption policy and whatnot. So there's a little bit of so-called tips for you. Pass back to you, Jerisa.
Yeah, and I think the last thing really, based on all of that advice that's been given earlier, if you think that the deal is too good to be true and the guarantees and the returns are, out of this world, check. And if you don't know where to check, you can always go to FIMM and ask for assistance. At least they will be able to tell you whether this is a genuine consultant or not. And even if they are genuine consultants, you need to use your common sense. At the end of the day, I think, regardless of all the checks and balances and protection that we can put in place, but your investment is your responsibility. So you need to do the proper due diligence to make sure that you are safe. Are there any other comments? We've over the years we've seen some pretty strange things. A lot of money changing hands, where a consultant comes along and says, never mind, just give me the money and I'll put it in my account and we'll invest it later. I mean, such things we've seen happen many times, and it's just sometimes mind-boggling that you would trust a stranger with large amounts of money going into their own personal accounts. So please, be careful. The other part is that, if you have someone that has your details and your particulars in terms of data which they should not be having, again, try and check to see whether these are legitimate parties. Again, FIMM, to the extent that we can, we will try and assist in this regard. We have this all the time. People call you up, they know your IC, they know your name, and there's always some catch to it, right? Something that they want to try and get you involved in. So be alert in relation to this, because unfortunately, a lot of our data is all over the place. And if you can imagine people going around, writing in books for contact tracing that we do now. If you don't carry a phone, there's a book, right? You need to write your name, give your address, give your phone number. anybody that takes a picture of the whole page gets, 20 people's name, addresses, and phone numbers. So it's not difficult to do. So I would advise everyone to just sort of exercise a dose of skepticism. Now, are there any last comments from the panelists?
Okay, maybe I can start. Oh, okay. Then after me, Edwin.
Oh, yeah, please.
Yeah,
Sorry.
I totally echo what Danny mentioned and Amir and yourself, Rizal. And more so during times like these, times are bad. There are a lot of people, who have lost their jobs and income is affected. So scams will continue to increase because everyone wants your money. So you need to be very careful. Give your money only with proper due diligence, and don't give out cash. Never ever give cash to any of your consultants. They're not allowed to take cash. Okay, they and you have to issue the check to the asset management company, or not to the agent's name. Okay, I also think that some people they are so trusting to the agent that they issue the check under the agent's name. It's like giving money to the agent. So don't try to avoid. Please don't do that. Okay, then if you want to say goodbye to your money, then go ahead. But yeah, I know at the end of the day now it sounds a bit scary. We've been talking a lot about scams and all these things, but as an investor, I think start small. If you are just first time investing in unit trust funds, I know we didn't mention earlier on about the benefits of unit trust funds and also PRS. But as an investor, because unit trust funds as low as 1,000 ringgit, some funds even 100 ringgit, you can start investing already and get access into professionally managed funds. So I think that's very important. So yeah, as mentioned by Danny and Amir and all, read the prospectus, read the product highlight sheet. There are a lot. This is a very regulated industry. In fact, as asset managers, we have to make sure our standards continue to go up. Okay, and regulators are always ensuring that we do our part. So I think that has kept us also on our toes all the time as asset managers, and we also want to do the right thing. Find a trusted advisor, because it's very important, someone that you can really trust, and somebody with experience as well. Okay, that's not just after your money for the sales target. Okay, thank you. Yeah, over to you, Edwin.
Okay, I think to just sum up a bit, back in my childhood time, when we watched TV, we saw the advertisement of a product and then we like it, we go and buy. Commonly is that whatever you see is whatever you get, right? But sad to say, I'm not sure good or bad to say now that things are coming to our handphone, our laptops, or your gadgets that you don't know whether it's true or false, right? And then the other thing is that now the world has become borderless with online. Everything is borderless. So sometimes product could actually suddenly appear in your gadgets, and it sounds very interesting to you. But as far as investment is concerned, especially unit trust, I think earlier on all the speakers, Amir and the rest, actually have shared. It's very important to verify. And I think one thing I probably will share over here to investors, the ID that Aimee has shared with you just now, the show with you just now. So for those investors, agents that come and see you, they have to carry that particular ID. Right, you can say that the ID could be fake. You can actually clone it. Yeah, it's quite easy to clone anything today. So, but what you can do is that you can do a verification going into FIMM website, fim.com.my. Okay, on the main page itself, you will see that there is a part that you can click that is saying, "Is my consultant authorized?" When you click that part, you key in the name, you key in the IC and the code, the agent code of that. Then you can verify whether the agent is a genuine or actually is a fake. So I think that is actually a very good verification whether you are getting the right the agent is the right agent or not.
Yeah, thank you. We are short of time, so I'd like to ask admin, because I'm having some problems with this Slido. I'd like to find out whether there are any questions for the panel. I've been trying to open this Slido thing for the last few minutes. Can somebody share what those questions are? And we can we can ask the panelists. Are there any questions?
Risa,
Yeah.
I have access to these questions. Maybe I would like to address a few of them. Right. One of it, actually, many of them touching about the fees, the upfront fees and the annual management fee. And some of them say that there are certain product without fees, and there's certain product charging about as high as 5-6%. I think this is actually something that you have to evaluate yourself. A cost of buying certain thing is a cost to you, but you have to look at the value of it. Don't look at just the fee. So if you buy for example, something that's low value to you, of no value to you, even you spend RM1, it's of no use to you. But if something that's very valuable to you, you spend sometimes 100,000, but it's valuable to you, you're willing to do it because it's of value to you. So you have to study the cost of it, whether the performance actually give you the kind of fee that you want to do. Second thing is actually the whether the consultant that you go through is actually of service to you, whether to share more information to you, whether they will continue monitor. Important is actually continue monitoring your investment and give advice, not just one time sell you, that's it, say you bye-bye 1 year later or 2 years later, I see you again, ask you to top up, not such a thing. Now make sure that they frequently visits you, understand your risk profile, because you can go to another robo-advice. I'm not saying the robo is no good, provided you update your own profile into the robo-advice, then they're going to analyze you and they advise you a new thing. But without doing so, the computer will only have your old data, right? So they will not able to change your profile and advise you accordingly. Whereas the consultant that earns some fee from you may be able to visit you and ask you a question and know about you, and they will recommend something to you. So that's very important. And sometimes, I mean, fee is one thing. Personally, I agree. Sometimes fee is very expensive. I agree with that. So actually, under the guideline, you can negotiate with your consultant. Sometimes you may want to top up more, negotiate the fee. It's always negotiable, right? But other than management fee is earned by the management company, where the management company has a hire researcher, fund manager to do the job. I think that 1-2%, not really that much per year, per year. And if it can produce you 8%, 10%, I think that's worth to do it, because the performance always net from the fee. Because one question is asking, the performance not net from fee. No, the performance in the fund table is always netted off the management fee and fund expenses, except the entry fee or the service charge that you pay to the consultant, right? So that's excluded. So you have to do your homework. Again, if you pay 5% for 1 year, of course you feel very expensive. But you pay, let's say, 2% for 10 years, you don't feel it, because the 2% service for lasting your 10 years investment is quite fair, for good service, what I mean for good service. So this is something that you need to look at it. And the other thing is, there's no best product. Someone asks you, which one is the best product? There's no such thing as best product. There's only better and better and better. And you should not look at 1 month performance, and someone consultant sell you 3 months, 6 month performance. Please educate them. Don't sell me short term. Look for 3 years, 5 years, 10 years, whether this fund is consistent. The other thing, once you buy into this fund, some of the consultants, I must say not all, some of them, maybe a small percentage of this, may ask you to switch. Do remember, some switch are free of charge. No, don't go to the trap that ask you to redeem it and you pay another 5% fee to go into another fund, and then another 3 months they can't you to redeem it because you make profit, go to another fund. Please don't do it, because like what you say, some of, I would say no, but there's more, 1 or 2 bad apples may churn your investment, just like 1 or 2 of these reminds here, keep you asking you buy, sell, because they earn commission, right? So better still ask the product that can give you the free switches, whether this equity fund go to the temporary money market fund before go back to that. And then one equity fund to another equity fund, maybe charge a very low fee, 1%, because you are assisting investor. Always look for those things. Don't look for churning every 3 months, sell and now buy another one, pay another 5%. Of course, you forever lose money. So that's very important. So again, there's no best product. You have to study or things. That is what I want to share. Thank you.
Thank you. I think we have had a very good discussion. We are at almost the last 5 minutes of the panel session, And I understand that the people who participate have an opportunity to get involved in the pop quiz, which will be organized by the admin team. So for now, I think it just leaves me time to thank my panelists, Mr. Long, Ms. Chan, Chair Amir, Edwin, Danny. Thank you so much for your valuable contributions. As per the recent presidential election, I'm glad that there's been no name calling. I haven't had to mute everybody, and you didn't blame everything on China. So this is a good development on the part of Malaysians who can discuss things rationally. Now, if I may, I'd like to thank you and for your time and wish you the best over this weekend, whatever is left of it. And let me pass it back to admin for the last 5 minutes, where I think they're going to share some pop quiz questions for the audience.
Thank you, Teresa. Thank you, everyone.
Thank you.